So, hi guys, good afternoon, all of you. So, shall we start? Sandeep, where are we? In the previous class, we started audit of items of financial statement, right, Sandeep?
Yes, sir.
So, till which part we have completed? I think we need to do only liabilities part, isn't it?
Yes, sir.
So, vouching of cash transactions, trading transactions, vouching of receipts, payments, expenses, revenue, all these things we have done. Then verification of assets and liabilities we entered. In that verification of assets we have completed. Non-current assets we have completed. Then tangible, intangible, everything we have completed. Then we entered into current assets. That is also done. I think we need to do liabilities part. Am I right?
Yes, sir.
Okay. So tell me, where are we? Which question? Any guess or any help on page number? So all this we are done. Verification of current assets. This is work in progress, inventory, goods sent on approval, verification of goods in bond, bills receivable, prepaid expenses. I think here we are. So is this, am I right? We have to start from question number 35, verification of liabilities. Guys, please do let me know, am I right? Okay. Let us start from here. So Sandeep, tell me one thing. When you are conducting audit of an entity, imagine you are the auditor. You are conducting audit of X Limited. When it comes to the liabilities of the entity, what will be your concerns? So what are you really concerned about, or what are you really scared of?
So first we need to check whether that liability is incurred on behalf of that company.
Okay, whether liability is incurred on behalf of company. Okay, very good. Next.
And whether they are paying it off according to the time.
Okay, repayment schedule. Okay, very good. Next.
Then check the accuracy, that means the amount that they are paying.
Okay, very good. Then first we need to start with Sandeep. When you are conducting audit of a company and the company borrowed money, first and foremost thing what you need to observe is the legal procedures, whether board of directors are authorized to take this loan, if they are issue of debentures, whether legal procedures are properly complied with. So first, let us understand company law. If I am director of a company, if I am director of X Limited, can I borrow money on behalf of X Limited? Representing as director of X Limited, can I borrow money? The answer is yes. But how much of money I can borrow? How much of money? Can I borrow 100 crores, 1000 crores, 2000 crores? So always there is a cap ceiling put by the Companies Act. So there are certain rules like, if the loans are, going beyond 100% of the paid up capital and free reserves, you need to take, the approval of members in the meeting. You need to call for shareholders meeting. You need to ask them, you need to tell them that this is the necessity. This is why we want to borrow money. And because tomorrow as a director, you can resign. As a director, you can resign, but still company and shareholders will be responsible for those loans. So board of directors of a company do not have unlimited or unrestricted rights to borrow money. There are always restrictions. There are always legal compliances. So as an auditor, you need to verify that. As an auditor, you need to verify that. Second thing is utilization of money. Say, for example, you borrowed 100 crores from State Bank of India. X Limited borrowed 100 crores from State Bank of India. For what purpose the amount is borrowed? For what purpose the amount is utilized, that also you need to verify. Even in Caro 2020, Caro 2016 also, if you see end use of money, whether you issue equity shares or whether you issue debentures or whether you go for any kind of loan, when you mobilize fund, what the management actually is doing with that fund is very important. Otherwise, what happens? Fund can be misutilized. You understand? Fund can be misused. So that should not happen. As an auditor, it is one of your responsibilities to see that the money is utilized properly, and you need to monitor that. If money is not used for the purpose for which it is raised, you need to report that in your Caro report. And if there is a fraud, you need to report in your audit report as well. You understand? Then comes whether the loan is a secured loan or unsecured loan. If it is security, what is the security? Is it hypothecation of any current asset? Is it a pledge, or is it, a proper mortgage? So on what charge or on what basis this loan is given, whether the charges are registered, whether you are maintaining any, statutory register for this kind of loans and all. So all these aspects the auditor has to verify. Then comes when you borrow money, there will be repayment schedule. So based on the repayment schedule given by the lender, whether you are properly repaying money or no, and after payment, after payment during the year, what is the principal amount outstanding as on the balance sheet date, that you need to verify. Because on the date of the balance sheet, whatever the outstanding money is, that should be shown in the balance sheet, isn't it? And if that is due in the next accounting period, you will show it as a current liability. If it is payable after 1 year, then you will show it as non-current liability. All these things are to be verified by the auditor. Okay, so as far as account balances are concerned, what are the audit assertions? We have discussed this many times. Again, we are saying this. Look here, existence, whether the liability is existing on the balance sheet date or no. Ownership, liability belongs to the client or no. Like Sandeep correctly pointed it out, whether it is on the name of the client entity or no. Obligation, assets will have rights. Liabilities are obligations. Even when you read accounting also, a liability is a present obligation. So whether the obligation is there or no, you need to verify. And then valuation of liabilities is not an easy task. Maybe in CA intermediate, you will not focus that much on valuation of liabilities, but going forward in CA final, valuation of liabilities is also a very big issue in financial reporting. So we have various accounting standards for valuation of liabilities. Maybe in our old accounting standards, like normal AS are there in your CA intermediate syllabus. No, in that for liabilities, there are no many accounting standards except something like AS 29. AS 29 speaks about provisions. No, that is one kind of liability. That's all. Other liabilities, you don't have guidance. But when you go to IFRS and Ind AS, there are many accounting standards which speak about valuation of liabilities. Many accounting standards. Maybe at your level, though you do not have this in syllabus, you might know accounting standard 15. There are some provision for gratuity kind of liabilities to be created, accounting standard 15. Then normal regular provisions and all, accounting standard 29. These kind of things, Okay, so in final, when you go, these are known as financial assets and financial liabilities, which fall under financial instruments category. Financial instruments, there are so many accounting standards. Okay, then valuation, then disclosure, then completeness, whether any liability is omitted. Even you remember the other day we were discussing about true and fair view. There are some of the guidelines. Okay, when the accounts are said to be proper, when the financial statements are said to be showing true and fair view, in that one of the points is no material asset, no material liability is omitted. There should be no omission. There should be 100% inclusion. All the liabilities must be properly accounted for, must be properly recognized. And another big risk in liability area is contingent liabilities. Now imagine there is a liability, there is a court case. The company knows that they are going to lose the case. But still, if they are not genuine people, they can show it as a contingent liability so that net worth of the company will, will appear more stronger. If you show it as an actual liability, net worth comes down, net asset value comes down. But if you show it as a contingent liability, it will not be in balance sheet. It will be footnote to balance sheet, only disclosure. That is also dangerous. The auditor has to verify. You have to scrutinize all the contingent liabilities, and you need to actually understand whether they are contingent liabilities or whether they are liabilities, but management is lying and management is just showing them as a contingent liability. You need to be very careful. So these are the points the auditor is concerned about. So the auditor has to ensure that the liabilities shown in balance sheet are actually payable. 2, are stated in the balance sheet at fair and reasonable amounts. Accuracy, valuation, represent obligations to the business, obligations of the business to third party. You understand? Here we said existence, obligation, completeness, valuation, disclosure. So all these things are explained in this box. So guys, I'll give you maybe 10-20 seconds of time. Read this box, that violet color box, whatever is appearing on the screen. Read that and try to understand. Once you completed reading, let me know. Okay, very good. So Sandeep, start reading ma. Question number 36, loans and borrowings.
Loans and borrowings. Creation of where a charge is created on assets.
Read properly. Creation of charge.
Yeah, okay, sir. Creation of charge. Where a charge is created on assets, confirm the appropriate disclosure and registration thereof with the ROC as per section 77 of Companies Act 2013 and record in the register of charges.
Very good. Next, MOA, AOA. Read.
Examine the MOA and AOA to see whether the company is empowered to borrow the money. Provisions under section 180. Ensure compliance of section 180 of the Companies Act as regards maximizing the loan amount that the company...
Right? Maximum loan amount, not maximizing. They are not profits to maximize, okay?
Yes, my screen was not visible, so...
Now it is fine?
Yeah, yes. Authorization. Ensure that...
No, wait. Ensure compliance of section 180 of the Companies Act as regards maximum loan amount that the company can raise or borrow. So as per section 180, what is the maximum amount? Section 180 of Companies Act. Okay, so let us see. These are basically the powers of board of directors. There is a ceiling limit. There is a cap on the power. So look here. What all this nonsense? This section states that the board of directors of company shall exercise the following powers only with the consent of company by a special resolution. So, dear board of directors, you are authorized to borrow money, but there are certain restrictions. to sell, lease, or otherwise dispose of the whole or substantially the whole of undertaking of the company, like you have a division. So you cannot sell off division without shareholders' approval. You need to take special resolution from shareholders. That is what they are saying. This is A. B, to invest otherwise in trust securities, the amount of compensation received by it as a result of any merger or amalgamation. So if you have any mergers and acquisitions during the period, and if you have received any money, what to do with that money? Can you put that in trust securities? Can you put that in another company? So that is B. C, to borrow money. Oh my God, this is what we are speaking about. So section 180 has a restriction on the board of directors' ability to borrow money, where the money to be borrowed together with the money already borrowed. That means already existing 4 loans are there. Now there is a new loan by the company, underline, will exceed aggregate of paid up capital plus free reserves and security premium. So what is the meaning? What is the meaning? Here, write down, according to section 180 of the Companies Act, write down, according to section 180 of the Companies Act, according to section 180 of the Companies Act 2013, the board of directors, according to section 180 of the Companies Act 2013, the board of directors can borrow amounts exceeding, board of directors can borrow amounts exceeding paid up share capital plus securities premium plus free reserves. Amounts exceeding paid up capital plus security premium plus free reserves. Only with the prior approval of shareholders' special resolution. Only with the prior approval of shareholders' special resolution. So if you are the auditor, you need to verify the special resolution. So you need to first check the amount of loan. If the amount of loan is exceeding, or this loan plus all the previous loans put together, if they are exceeding 100% of the paid up share capital plus security premium plus free reserves, then you have to verify as an auditor whether any special resolution is passed by the shareholders or no, giving authority to the board of directors to borrow money. Otherwise, it is incompliance, non-compliance with the Companies Act now. Directors will be personally responsible then. Sandeep, you understand this point?
Yes, sir.
That is given in the next point. Ensure that proper resolutions by shareholders have been obtained for excess borrowing. What is excess borrowing? If the borrowings are going beyond share capital, free reserves, and security premium, that is called excess. Then shareholder resolutions. And the auditor has to verify minutes book resolutions approving the borrowings. So you cannot just inquire. You went to board of directors and you asked, as an auditor, you asked, hey, directors, this amount is exceeding 180 limit. So have you taken any resolution from shareholders? Director said, yes, sir, we have taken resolution. Okay, no, you cannot inquire. You have to verify. Open the minutes book. See the resolutions passed. Whether the resolution is, submitted with the registrar of companies. All these things you need to verify. That is, check the minutes book. Then internal controls. Ascertain that the purpose of borrowings and manner of utilization is acceptable and that it has not prejudicially affected the concern. So what is the purpose of borrowing? What is the manner in which the borrowed fund is utilized? Is it against the benefit of the company? That you are verifying here. External confirmation. If I am the auditor, I am conducting audit of X Limited. X Limited borrowed 100 crores from HDFC Bank. The auditor will write to HDFC Bank, dear bank manager, I am conducting audit of X Limited. X Limited borrowed money from your branch. Could you please confirm what is the amount outstanding as on 31st December or 31st March 2022? Then I will get direct confirmation from HDFC Bank. That you need to do. This was one of very big issues in Satyam's fraud. PricewaterhouseCoopers, when they conducted audit of Satyam, they have not taken external confirmation on bank loans. Very big issue. Then supporting and documentation. Obtain a certificate from the bank showing particulars of securities deposited. So HDFC Bank will also give in writing to the auditor stating that, yes, we have given 22 crores loan to this particular company on the basis of so and so security. These are the properties given to us as security. And the security is registered. The mortgage is registered. All these things. Then external confirmation, obtain direct confirmation from the lender that already we have seen. Extraordinary matters. Identify any extraordinary matter which may lead to further inquiry. For instance, belated payment of interest, etc. That means payment of loan installments is not regular. Why it is not regular? In case if it is something like, lease payments or hire purchase, if you are not paying that properly, the lessor can come and take his asset away, no? If it is bank and you are not paying interest or principal amounts regularly, they may, after giving appropriate notice, they may auction the property. So that also auditor will verify. Disclosure. Loans and borrowings should be shown as short-term borrowings and long-term borrowings. How will you segregate short-term borrowings and long-term borrowings? Total, say for example, 20 crores is taken from State Bank of India. 20 crores. In that 20 crores, whatever is the amount that should be paid within 12 months from the date of balance sheet, you'll put in short term. Beyond that, whatever you have to pay, you'll put it in long term. Even debentures, it is same. You issue debentures worth, say for example, 40 crores. In that, redemption, stepwise redemption is there. In the next 12 months, whatever the redemption amounts you need to pay, that will be shown in the short-term borrowings, current borrowings, current liabilities. Beyond 12 months, whatever you are required to pay, that will be shown as non-current liability. That is to be properly segregated. Disclosure. Analytical procedures means calculation of ratios, comparison of relationships and all. Compare the following certificates with the financial statements. 1. Interest charged on loan account during the period under audit. 2. Amount due to bank or ledger as at the balance sheet date. Amount due to bank or ledger. It should be lender. Amount due to bank or lender. This, I think it is not ledger. It is lender on the date of balance sheet. So this is for all long-term loans. Whatever the name of long-term loan is, this is how you need to verify. Okay, guys, all of you understand this. If you understand this, 90% of liabilities verification is over. Sandeep, any doubts, ma?
No, sir.
Shall we go to trade creditors?
Yes.
Read.
Trade creditors. External confirmation. Obtain confirmation of balance from the creditor directly.
Okay.
Cut-off procedures. Examine the documents relating to receipt of goods from suppliers during a few days immediately before the year end and verify that the related invoices have been recorded as purchases of the current year. This is to ensure that proper cut-off procedure.
So tell me what is this? Read this and explain what this para is, Sandeep.
Yes, it talks about if we have made any purchases during the year, we need
not
to ensure
during
that
the year, just before the balance sheet date. Balance sheet date is 31st March. You bought goods on 28th March, 27th March. So whether invoicing is properly done, whether the purchases are properly recorded and the liability is credited to the creditor or no, you need to verify.
Okay,
because
sir.
you ordered goods on 30th March. You purchased goods on 30th. Goods might have been received on April 4th.
Yeah.
But still purchase will be recorded based on the accounting policy. No, the company will have an accounting policy which should not be against any accounting standard or law. So on what basis company is recording the purchases on 29th, purchases made on 29th March, the auditor has to verify. You understand it?
Yes, sir.
Next, read the next point.
Extraordinary matters. In case there are any unusual payments around the year end, examine them thoroughly.
So many adjustments will be there. Year end, so many adjustments will be there. You have to verify them thoroughly. Next.
Subsequent payments. The auditor should review subsequent transactions to identify or confirm material liabilities outstanding at the balance sheet date.
This is very interesting and very useful technique. Okay, very effective technique. So Sandeep is conducting audit of, say, Pavan Limited. In the books of account of Pavan Limited, Pavan said on the date of balance sheet, 31st March, Pavan said, I need to pay 1 crore rupees to X Limited. Now Sandeep came and asked as an auditor, hey Pavan, you have to pay 1 crore rupees. Yes. To whom? X Limited. Pavan, why you need to pay 1 crore, Pavan? Then I said, I bought the goods. They are our suppliers. I need to pay. Then you asked, normally what is the credit period they give? Then I said 45 days credit period. Okay. That means on balance sheet date, whatever 1 crore rupees outstanding is, definitely that will be paid in April or at least in first 1-2 weeks of May. No, if credit period is 45 days, if credit is already existing on the balance sheet date, so from balance sheet date within next 40-45 days payment should be made. So what Sandeep will do, he will ask for bank statement of 2022 April. Auditor asked 2022 April bank statement. Then accountant got shocked. Accountant asked, sir, you are conducting audit of 2021-22 financial year, no? Yes. That means up to 31st March only, no? Yes. Then why are you asking cash book or bank statement of the next year, subsequent period? Because on the date of balance sheet, whatever the outstanding amounts are, I will see in the next period if they are paid or not. In April or May, if this 1 crore rupees is not paid on the date of balance sheet, that 1 crore rupees might be a fake number also, a wrong amount also, who knows? If it is genuine amount, you will pay it in April or first week of, or first 1-2 weeks of May. So verify subsequent payments. You understand? Then disclosure, trade creditor should be shown as trade payable as per schedule 3. Are you kidding me? Obviously. Trade creditors will be shown as accounts payable. Then contingent liabilities. Oh my God, put a star mark. Important. So Sandeep, how will you verify contingent liabilities of my company? See, how can you know when you are conducting audit of X Limited? How will you know how many cases are there on company? You never come to know.
Okay, sir.
So it is the responsibility of the management of the company to inform the auditor, dear auditor, we have 14 court cases pending. These are the case details. It is my responsibility to be the management to give information to you. Otherwise, imagine if you are auditor of X Limited, how will you come to know related parties of X Limited? How will you come to know court cases of X Limited? You cannot. That is why you obtain management representation letter 580. So the director will go to the auditor will go to CFO, the auditor will go to CEO, the auditor will go to finance director, and he will ask, sir, are there any contingent liabilities? CFO said, yes, sir, we have contingent liabilities. From where these contingent liabilities came? Sir, there are 14 court cases, sir. Then the auditor will ask, could you please write it on the letterhead of the company? CFO has to write it on the letterhead of the company to Mr. Sandeep, auditor, subject, management representation letter, for the year 2011, 2021, 2022. Dear sir, this is to bring to your kind notice that we have 14 court cases pending. These are the details. We are furnishing all the relevant papers to you. And to the best of my knowledge and belief, we do not have any other case on us which is giving rise to contingent liability. All the contingent liabilities are properly assessed, properly disclosed in notes to accounts. We do not have any contingent liability which is not disclosed. In writing, you will get it. Then that 14 court cases, whatever are there, that you will study. If required, you'll go to the lawyer of the company, you'll go to the legal advisor of the company, or you'll speak with the company secretary of the company, or if company has internal legal department, you'll go and speak with the legal manager. And then you will ask, dear legal manager, I am conducting audit of your company. Could you please explain about this 14 cases, please? He has to explain because obtaining information from the employees of the company is your statutory right. So if Sandeep as an auditor goes and asks, hey, please explain about these 14 cases, lawyer cannot say, no, I will not tell you. Maybe if it is external party, he is not a legal manager inside the company, he is outside lawyer, he may say, no, confidentiality, I will not give you some information. That is possible. But if it is in-house legal department, they cannot tell you that because they are employees of the company. You understand? That you'll do here. So meaning, what is contingent liability? Meaning is given. Lawsuits, legal disputes, court cases, settlements, these kind of things. Supporting documents, pending legal cases, supporting documents. Written representation by management, SCA 580. Accounting standard, AS 29. That is this. Very important question from exam point of view. Contingent liabilities is very important. Then income tax. Okay, when you understand, above para, in this para, I have clearly explained you all the loans and borrowings. No, now when you are verifying this debentures, again same thing will come. No, creation of charge, already we have completed. Supportings and documents, already we have completed. Memorandum of association, articles of association, already we have completed. One new point came, debenture trust deed. Obviously, if you are issuing debentures, there should be debenture trust deed. So these points you'll be easily able to cope up with. So you don't need to struggle now. Because you understood the overall, responsibility of the auditor, it will be a cakewalk for you to understand these things. Okay. Then provisions, verify the provisions regarding redemption. If there is any redeemable amount, whether amounts are transferred to debenture redemption reserve, whether any sinking fund is created out of that debenture redemption reserve investment, statutory rules are there. You might have studied that in your group 1 accounting also. Redemption of debentures. Interest repayments, presentation, how to show duties of debenture trustees. This is law part. This is not auditing part. Okay. Then provisions, AS 29. I'll not speak anything about this. Just all of you read these provisions. I'll give you 30 seconds of time. Read these provisions. Once you are done with this, let me know in the chat box. Okay. We'll do 1 2 other important items and then we'll call it the day for this particular topic. Then we'll go with some other chapter. Very good. So everybody done? Okay. So next question is bills payable. I'm giving this to you. Verification of profit or loss arising on sale of plots held by real estate dealer. Put a star mark. These kind of questions usually appear in RTPs. Okay. Sometimes to surprise you, these kind of questions can be asked in the exam also. Verification of dividend declared out of reserves. Put a star mark. All these are legal provisions. That's all. MCQ. So that's it. So Dharini, can you read question number 43 fast?
Yes, sir. Verification of profit or loss arising on sale of plot held by real estate dealer. The land held by the real estate dealer shall be current asset and not fixed asset.
Obviously, because that is stock in trade for him, no? That is stock in trade for him. So it is a current liability, current asset.
Verification of profit and loss shall be done in the following ways. A. Each property account should be examined from the beginning of the development with special reference to the nature of charges so as to find out that only the appropriate cost and charge have been debited to the account and the total cost of the property has been set off against the price realized for it.
What is the meaning of this para, you know, ma? So you acquired one land with 1 crore rupees and you have incurred some expenses for its development, registration, etc. So you will add all that incidental costs and you will show this at 1 crore plus all these amounts, 1 crore 42 lakhs. For example, you bought one old house and you demolished it, you developed it, you have done all the land leveling. You understand? So that 42 lakhs, whatever is there, that should be added to this. Yes, now, sir. When you sold it for 1 crore 75 lakhs, it is not 1 crore which is to be reduced. It is 1 crore plus incidental expenses 42 lakhs you need to reduce. That is what they are saying in this para. You understand it?
Yes, sir.
Read BC also fast.
The basis of distribution of the common charges between different plots of land developed during the period and the basis of allocation of cost to individual property comprised in the particular piece of land should be scrutinized.
Very good. Next.
See, if the land price lists are available, these should be compared with the actual selling price obtained, and it should be verified the contracts entered into in respect of sale have been duly sanctioned by the appropriate authorities.
Very good. Read BC points, all of you, once again, ma.